Okay, we're going to get started. Thanks for joining us today for our webinar on tackling holiday returns. My name is Melissa Geringer. I oversee communications for Bstock and will be serving as host and moderator for today's webinar. As we get into the presentation, please feel free to use the portal on your screen to send in questions via the Q&A tab. It's on your toolbar. And depending on the question, we might stop to answer it. And we're also going to do a Q&A at the end of the presentation. So with that, I'd like to welcome our guest speaker, Eric Moriarty, Vice President at Bstock. Eric has decades of experience building online marketplaces for both B2B and B2C. This includes writing the business plan for product category strategies at eBay, where he was the company's first category manager. At Bstock, Eric has helped build and nurture relationships with some of the world's largest retailers, helping them recover hundreds of millions of dollars for their excess and return merchandise via our marketplace platform. Welcome, Eric.
Thanks, Melissa, and thanks to everyone in the audience for joining us today. We understand people are busy getting ready for the holidays, and there's lots to talk about, so we tried to keep the message as concise as possible, and then at the end, we'll have time for Q&A if people have any questions. And as Melissa mentioned, please use the technology to raise your hand if you have a question during the presentation, and we'll try and get them as they come in. So today's topic is about the holidays and not the fun and excitement of selling to customers before Christmas, but more about how to best handle the growing number of returns that are coming back after Christmas, specifically focusing on how to maximize your recovery on these items once they're returned. So there have been some recent trends in retail that is driving the volume of returns higher and higher each year. First and foremost, the holiday season is getting much longer, and it's filled with endless promotions, price discounts or deal busters, anything to get customers into the store. But Black Friday is now bled into Thanksgiving. Last year, online sales for Thanksgiving Day was over $1 billion. So, and Cyber Monday has completely unraveled. It's now Cyber Month. So companies are doing everything they can to get customers into the store, including offering a really lax customer return policy. There's a lot of data that shows that a liberal customer return policy is a big reason why shoppers will pick your store instead of someone else's. Additionally, more and more people are buying online, where customer return rates are much higher. E-commerce return rates are somewhere around 30%, whereas brick and mortar return rates are closer to 8 to 10%. So all of these trends are driving a significant increase in customer returns year after year, and the biggest return season is post-holiday. Approximately $100 billion is going to be returned after Christmas this year. So, whether it's the ugly sweater from grandma or the pair of shoes that doesn't fit, more and more people are returning it to the retailer because it's so much easier than it used to be. So all the profits that you made from the pre-Christmas frenzy are going to get crushed during return season unless you have an efficient and effective solution for dealing with this inventory after it comes back. So once an item comes back, there are several options that companies traditionally use to dispose of their inventory. They can return it to the vendor, they can put it back on the shelf, or they can liquidate it. And what we're finding is that many companies don't actually factor in all of the costs associated with some of these channels. They focus on top-line recovery rather than bottom-line recovery. And by focusing on top-line recovery, this is actually causing them to mismanage their inventory by allocating it to channels that produce inferior results. So, it's very important to understand the economics behind each one of your remarketing channels and really try and figure out how much is actually flowing to the bottom line. So let's look at a couple rudimentary economic models comparing liquidation to some of these other channels where top-line recovery might be actually a bit deceiving. So here's a look at RTV, return to vendor. So when looking at RTV, many companies don't factor in the hidden costs that lie in cost of goods sold. They think they're getting 100% recovery on that vendor's customer returns and unsold inventory. Well, the reality is the vendors are marking up their pricing to accommodate for the costs to ship the inventory back to them and resell it. Well, what would happen if you didn't ship it back to them? How much money would they save? What we're finding is that a lot of our clients are actually renegotiating their vendor contracts and lowering their cost of goods sold in exchange for not returning the inventory. and then they're turning around and liquidating that product instead. So in this model, this company has renegotiated their vendor contract, and they're now getting a 10% discount on their cost of goods sold. And they're getting that discount because they're keeping the inventory rather than returning it. So this is having a net savings to the company of $1,000. So rather than paying $11,000 for the 100 units, they're paying $10,000. However, they're giving up their return to vendor credit of $1,650. So they're keeping the 15 units rather than returning to the vendor and getting that return to vendor credit of $1,650. So they're saving $1,000 in cost of goods sold, but they're giving up $1,650 in return to vendor credits. So they have a net loss of $650. However, they still have those 15 units. So as long as they can liquidate those 15 units for more than $650, they're actually making more money. Another way to look at it is, they think they're recovering 100%. They're recovering 100%, the $1,650 when they return those 15 units. The reality is they're not recovering 100% because they're paying $1,000 more. So they're actually recovering only $650, which is right around 40%. So instead of recovering 100% in an RTV program, they're actually really only covering, around 40%, again, in this model. So let's take a look at back on the shelf. A lot of companies are putting items back on the shelf, and there are a lot of costs associated with selling customer returns and overstock inventory one at a time to the customer that companies really aren't factoring in. So there's warehousing costs, there's logistical costs for each item. You're not going to sell everything all at once. So depending on how long it takes to move all that inventory one at a time, there's costs associated with that. And the same is true of cannibalization, right? By putting that item back on the shelf, you're taking up shelf space, and you're selling this inventory to your customers that walk in the door at a discounted price. And that shelf space could otherwise be taken by fresher, higher margin, full price inventory. And in today's highly competitive environment, keeping your inventory fresh and in season, keeping your shelves full of new stuff is one of the keys to winning the mind share of the customer. So again, this is just a rudimentary model, but as you can see, after you factor in all of the costs, including freight and storage and customer service and cannibalization, the bottom line recovery is actually a lot smaller than the top line recovery. So instead of recovering 60% of MSRP, the company is actually only recovering 23%. So as long as your liquidation channel produces more than 23% of MSRP in this model, it's a more profitable way to go. So one of the biggest reasons that companies historically have chosen these other channels instead of liquidation is because older methods of liquidation are extremely inefficient. They yield very low prices, pennies on the dollar. So this is a graphic that is sort of representative of, a typical old way of liquidating. So the company, the retailer or manufacturer, has excess inventory. It's customer returns, it's overstock, it's damaged goods, anything that is excess. And they're selling that excess inventory in bulk to a large liquidator. Well, what that large liquidator is doing is they're breaking that inventory up into smaller lots, marking it up, and selling it to smaller liquidators or jobbers. And what those jobbers are doing is they're taking that inventory, breaking it up into smaller lots, marking it up, and selling it to resellers. And those resellers are ultimately the companies that are selling the inventory directly to the end consumer. So there's all these middlemen in this old way of liquidating that are capturing a ton of margin. And they're professional negotiators. Their job is to negotiate you down in price. So they're constantly going to tell you things like the market's not what it used to be, anything that will get you to take a lower price, because that's how they make money, is they get you to take a lower price, they mark it up, and they sell it to the next guy. So this is the old way of liquidating, and when companies are comparing this method of liquidating to some of these other channels, you can see why they might think those other channels are actually more attractive. However, there's some new and exciting ways of handling excess inventory, and at Bstock, we are one of them. So the best way to explain what we do is to really show it. So I'm going to kind of go over to the web here. So this is our corporate site, and I'm going to click on the marketplaces page, and these are all of our clients. So what we do at Bstock is we operate private online auction B2B marketplaces that help our clients make more money on excess inventory. Things like customer returns, basically the inventory they used to sell to the liquidators and the jobbers. And what we do is we build for each individual client their own private online auction marketplace. So let me take you to one as an example so you can see what it looks like. So this is a site that we built for Walmart, we host it for Walmart, and we manage it for Walmart. All Walmart does is send us a very large Excel file of inventory, and then we break that inventory up into smaller lots and create all of these listings, and we list them on their marketplace. And then we drive buyers. And as you can see, these listings are B2B listings. They're not designed for consumers. So this is 5 pallets of TVs, not a single TV. So the buyers in all of these marketplaces that we run for our clients are those resellers that I was telling you about in that previous example of the old method of liquidation. These are the companies that pay the highest price for your inventory. So let's take a look at what their experience would be if they clicked in. Let's say I was interested in this particular listing. I want to click in. I can't see any more details about this inventory, and I can't place a bid because I'm not logged in. So only companies that are approved by Walmart can actually view and bid on their inventory on this marketplace. So these marketplaces are private, and that is a very important aspect of our solution that our clients value very much. So I'm going to click login, and it's going to take me to a login page. So I'm an approved customer. If I were to try and log in, I would have to agree to Walmart's terms and conditions. Okay, these terms and conditions are the rules that were written by Walmart, their legal department, and they govern the transactions between Walmart and their approved buyer base on this marketplace. So whatever your rules are for doing business with you, those rules go here. And every time a buyer logs in that is approved, they have to agree to those terms and conditions. Additionally, one of the other things that we do at Bstock for our clients is we drive those resellers. We drive buyers to their marketplace on an ongoing basis. So if a customer wanted to come and register on the site because they were interested in bidding, they would have to go through a registration process. And when they got to the end of that registration process, they would go into a pending status. They wouldn't automatically get approved. So we have a team of people here at Bstock where that's their job. Their job is to review the registrations on all of our clients' marketplaces and approve or deny them based on the client's specific criteria for approval. So whatever Walmart's criteria for approval is, the team here at Bstock is vetting the registrations that come into this marketplace based on that specific criteria for approval. So what these two things do is they allow Walmart to have complete control over to their channel and over their brand. You know, not anybody can just buy from them. Only approved companies can buy from them. And when they buy from them, they have to abide by their rules. So I'm not going to log in because that's the point. It's a private marketplace, and there are people on this webinar that are not approved customers, and only approved customers are able to log in. But if I were to log in, what you would see is there would be a bunch more information down here underneath this listing. There would be information about exactly what's in the listing. You could download a manifest. You could learn about what their shipping policies are, what the condition is for this particular listing. Anything specific to this listing that's going to help the buyer make a buying decision. And the buyer would be able to bid if they were logged in. The last thing I'd just like to show you on this listing is this is all the bidding activity that's taking place on this listing. So there have been 23 bids placed by 9 separate bidders. So on average, each bidder was outbid 1.5 times, and they've come back and bid again. And each one of these buyers will keep coming back and bidding again until they've truly reached the highest price that they're willing to pay for this inventory. And ultimately, the lot will sell for the highest price that the market is willing to pay for the inventory. So rather than the liquidator or the jobber negotiating you down on price, these resellers, again, who are the companies who pay the highest price for your inventory, they're bidding against each other, driving prices higher. So the net effect of all of this is that our clients are making significantly higher prices. Most of our clients make anywhere between 30 to 80% higher prices when they switch to our solution over how they used to do it. So that's how it works at a high level. And what I'd like to do now is kind of just tell you about one other thing that we do that has a huge impact on increasing our clients' recovery over how they used to liquidate inventory. So one of the biggest things that we do is we study the data. So I'll just sort of switch back real quick. These are all the marketplaces that we run, and they include 9 of the top 10 retailers in the United States, along with many other very large companies. And behind all of these marketplaces that we run is an enormous amount of data. And in fact, the team here at Bstock, a lot of us used to work at eBay in the early days. So we've been studying the data behind marketplaces for the last 20 years. And what I can tell you for sure is that all of this inventory on Walmart's site, we could split this inventory up a different way with the same exact buyer base, and Walmart would get completely different results. So how you do it really matters, and that's one of our greatest strengths that we bring to our clients is we study the data to figure out what is the best way to sell inventory to make our clients the most money. So the other thing that I would like to point out is that there isn't an answer key. You know, the solution is not actually one specific answer. What works best for one particular client in one situation at one point in time is not going to be what's best for another client at another situation at another point in time. So the answer is not an answer key. The answer is an ongoing process of data analysis and continuously optimizing and maximizing recovery for the client. So let me take you through some real life examples of when we've done this. This is an example of a client where they were selling inventory in mixed lots, and they were putting all kinds of inventory in a mixed lot, and the data suggested that if we broke the inventory out into some category specific listings, that they would make a lot more money. And we did. So we broke out all of the grocery items into their own lots, and when we did that, prices went up 72%. When we broke out the jewelry and linens listings into their own lots, prices went up 54%. And when we broke out the consumer electronics into their own lots, prices went up 42%. And the thing is that the remaining inventory in the mixed lot did not change in a significant way. It was sold for around the same price. And so these price increases are net price increases. So again, it's the same exact inventory, the same exact buyer base. All we did was change how it was being sold and achieve significantly higher prices for our clients. So this might seem like an obvious example, right? Don't sell your grocery items mixed in with your consumer electronics. There are different buyer bases for that. So let me take you to another example. It's a subcategory example. This is a client of ours that was selling apparel, and they were selling the men's and women's and children's clothing all mixed together. And the data suggested that if we broke out the men's and women's clothing into one lot and the children's clothing into another lot, the prices would go up. And when we did, prices went up 32%. So again, the same inventory, same buyer base, all we're changing is how it's sold. Here's another example. MSRP per unit has a high correlation to recovery. There's a myth out there, that says that the way you sell your dogs is by mixing them in with your stars. The data suggests that the vast majority of time, that's not true. Here's an example on the right where it's a client that has a wide range of MSRP per unit in their product base. So they have very high priced items and they have very low priced items. So they were previously selling it all mixed together. And when we broke out the high priced items and put them in their own lot and put the low priced items in their own lot, the average price of both went up 89%. So again, same inventory, same buyer base. All we did was change how it was sold. Here's another example related to auction size. So, a lot of times selling inventory as a truckload, there's a lot of buyers out there for that size of a lot. But there is a even much larger buyer base out there for smaller size loads, because there are just a lot of companies that can't afford to take the risk on a large truckload, but they will be able to afford and have a business that moves, 1 or 2 pallets at a time. So because there's more of them, there's more competition. So that typically leads to higher prices. So here's an example on the right of a client where they sell inventory, same inventory, but just in different lot sizes. So the left bar is the listings where they were selling inventory in 13 to 24 pallet loads. They also sold listings in 7 to 12 pallet loads, which is this middle bar. And the average recovery for the listings with 7 to 12 pallets was 6% higher than the listings with 13 to 24 pallets. And they also sell listings in the 1 to 6 pallet range. And those listings on average were 16% higher than the listings with the 13 to 24 pallets. So in this example, for this client, selling in smaller lots makes them more money. But this is a great example, actually, of there isn't an answer key out there, right? The answer is about studying the data and figuring out what works for a particular client at a particular point in time in a particular situation. So here's an example where the exact opposite is true. This is a client that sells rugs. And they were previously selling rugs by the less than truckload, 1 to 2 pallets, 4 to 6 pallets. Well, what the data suggested was that if we aggregated all of those less than truckload listings and created one larger truckload listing, that the prices would go up. And we did. We aggregated all the listings into one. We created a truckload listing, and that brought in some really large buyers who wanted to buy by the truckload, and prices went up 185%. So again, same inventory. All we changed was how the inventory was being sold. So these are all just examples of lot configurations. There's all kinds of variables that we study. Here's an example of another metric that we take a look at, which is the starting bid price of auctions. So in online auctions, this is, there's an enormous amount of data out there about this, but the best way to make the most money using an online auction is to start the bidding low and let the market price it out. Sometimes companies are a little nervous about that, and they are hesitant to do that because they're nervous that a listing is going to sell for below the price that they want to get. And so here's a case study of a client that was hesitant at first. They were listing during this time frame where they were starting the bidding at a higher price. They were starting at the price that they were hoping to get. And it was working. They were selling some inventory, but we finally convinced them to try our idea. We kindly convinced them to start the bidding low and let the market price it out. And when they switched to that strategy, prices went up 29%. I mean, a massive price increase. So I guarantee you there were listings in here on this right part of the chart where some of those listings did sell for below what the client hoped they could get. Some of them sold for quite a bit more. The average recovery was 29% higher. So again, same inventory, same buyer base, all we're changing is how it's done. So these are just some examples to illustrate the point that, there is a better way out there. These old methods of liquidation are outdated and they're inefficient and they yield really low prices. And there's some new methods out there that yield significant prices, and there's lots of value. It automates manual tasks. It speeds up the sales cycle in some cases. So we have a client that has actually shut down several warehouses as a result of using our solution, because we've increased the buyer base such that they're able to move more inventory faster, so they need less space to store it. And so they were able to shut down several warehouses. So there's all kinds of value, but the primary value is it increases prices. So our clients are typically getting a 30 to 80% price increase on average over how they used to do it. So let's walk through what kind of impact this price increase can have on your bottom line. This is an example of a sample retailer. Their revenue is $1 billion. We're estimating that their customer returns and overstock inventory is about 15% of their business, so 150 million, and that their current liquidation channel is yielding 10%, so $15 million. So what if this client switched over to a new way of doing it, tried one of these new ways, and it got them a 30% price increase just by changing how they're liquidating the inventory? Well, that 30% is $4.5 million, and it all flows to the bottom line. So the typical operating margin of a retailer is about 5% or $50 million. So when that $4.5 million flows down to the bottom line, your bottom line goes up by 9%. So this can have a significant impact on your margins. And this day and age, when the market is so competitive and margin is really hard to come by, this is a very viable option for companies to look at as a way to drive their bottom line in their company. So to sum up, there are all kinds of costs that are in companies' remarketing channels, and it's really important that you focus on your bottom line recovery rather than your top line recovery. And there's new methods of liquidation out there today that are making companies significantly more money. And when you compare that to your other remarketing channels, what we're finding is that a lot of our clients are driving more and more volume through their liquidation marketplace because it's getting them much higher recovery than their alternatives. And one of the keys to doing that, in addition to all the buyers that we're driving to create that competition, is really analyzing the data and studying what is the optimal way to do this. Because you can take the same inventory with the same buyer base and achieve completely different results just by changing how you do it. And the way you figure it out is by studying the data. So with that said, I'd like to thank everybody for their time and turn it back over to Melissa.
Great. Thanks so much, Eric. We're going to go ahead and jump into the Q&A portion. So I had this one come in. On your marketplaces page, I noticed that some of the marketplaces are branded and some are unbranded. Can you explain the benefits of having your own branded marketplace?
Yeah. Let me go to the marketplaces page. So as you can see, we work with quite a few very large companies that have very valuable brands. And in the vast majority of cases, those companies are using those brands to help drive buyers to their liquidation marketplace that we operate for them. But there are several reasons why a company might not want to use their brand. And with our solution, that is an option if that's something that was important in your business. So I'm just going to take you to an example of one. Here's a marketplace that we run called Mobile Carrier Liquidations. The site is branded Mobile Carrier Liquidations, and I'm just going to take you to the terms and conditions. This is all public information, so I'm not showing you anything that I shouldn't. When you click on the terms and conditions, you can see that this marketplace is actually AT&T. So we can't talk about, the specifics of any particular client about why they might make that decision. All I can say is that with our solution, you can make that decision. However, if you do, the data shows that the difference between a branded site and an unbranded site typically is about a high single digit to low double digit increase in recovery. So we have examples of companies that have switched from unbranded to branded, and when they did, their prices went up. So all that happened was they went from unbranded to branded. So an example of that is Amazon. They launched as an unbranded site, and when they switched over to branded, the prices went up. So it makes a big difference, but it is your choice.
Great, thank you. All right, next question. Where do your buyers come from and how do you find them?
So we've been in business since 2009. It's about 8 years. And when we started out, we didn't have all these clients. We had one client. And over the last 8 years, we've been building up our network of buyers and sellers. So we've been building up all these sellers over the years. And now we have a very large network of liquidation marketplaces for very large companies. And there are millions of resellers out there who want to buy this inventory. They're the companies that were buying from the liquidator that you sold to. So this network of inventory from all of these companies is extremely attractive to those resellers. And so one of the biggest things that we do is we drive buyers. So we've been building this buyer base up for the last 8 years. So when we launch our next marketplace for our next client, we're going to bring to the table all of the buyers that we have built up over the last 8 years. In addition, we're going to continue to drive buyers on an ongoing basis. And we're going to use normal marketing techniques. We do online advertising. We do keyword buys. We do PR. We go to trade shows. We do trade magazines, social media, everything under the sun to try and drive buyers to our clients' marketplaces. And this is one of the places we spend the most amount of time, money, and resources at Bstock, because we know that more buyers is going to make more competition, and more competition is going to increase our clients' prices. So it's one of the biggest things we do at Bstock.
Great, thank you. Okay, next question. This is coming from a manufacturer. I'm a manufacturer and I'm concerned with my brand or label getting into the wrong hands. How do I make sure my brand will be safe?
So I'll go back to the Walmart site to illustrate this point. So we provide a couple tools that are critical to this point. And I'm going to just log in here, go to the login page. So when I was doing the demo before, I was telling you about the terms and conditions that are written by the client. So whatever your rules are for doing business with you, they'll be right here. And the buyer will have to agree to them every time they log in. So however you do business, those are the rules that will govern the transactions between you and your buyers in your marketplace. Additionally, you have control over who can buy. So when somebody registers, they go into a pending status, and we have a team of people here at Bstock where that's their job, is to vet those registrations based on the client's specific criteria for approval. So those are the two primary things that we provide to you to help you have greater control over the channel. And when you compare this model to a traditional liquidation model, in a traditional liquidation model, oftentimes I'll hear companies say, well, I want one throat to choke. So they sell to the liquidator, but all that liquidator is doing is breaking it up and selling it in smaller lots to other liquidators who sell it to the resellers. And so when you do it that way, you have no relationship with the reseller who's ultimately selling it to the end consumer. So in this model, the reseller is able to bid directly from you, and when they buy inventory from you, they are governed by the terms and conditions of your marketplace. So you have a direct relationship which is greater than the indirect relationship you might have with old methods of liquidation.
Super, thank you. All right, we'll do one last question here. It's a two-part question. Do you handle and warehouse the inventory, and do you have shipping partners you work with?
We do have shipping partners. We do not handle the inventory. The best thing that you can do is not touch the inventory and ship it back and forth from one location to the next a million times. You eat up a lot of the value by incurring those costs. So the best thing that you can do is sell the inventory as is, where is. So wherever it lies today, sell it from that location. If you're not able to do that and you need to remove the inventory, then we have partners that we can bring to the table. So we partner with C.H. Robinson, and we integrate them into our platform. And so if a client wants to use those services, they can, but they're not required to. And it's, all of the warehousing and logistics services that you might imagine, freight, warehousing, those kinds of services. We don't provide them, our partner does.
Great, thank you. Well, thank you again, Eric, and thank you to everyone for taking the time to listen today. We really appreciate it. Eric, I'm going to have you flip back to your to the page with your contact info on it. So if anyone has any additional questions, feel free to reach out to Eric directly. And I'm also going to be sending out a follow-up email with the presentation included. So again, hope everyone has a great holiday season, and here's to minimal amounts of ugly sweaters getting returned. Thanks very much, everyone, for joining us today.